Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Taylor Ingraham, partner at ASC Advisors, Jon Costello, managing partner at Devon Park Advisors, and Abdul Abdirahman, principal at F Prime. We're here to discuss private markets, deal flow, and the rise of secondary activity. It is great to have all of you with us. Welcome to Trade Talks. Taylor, I'm going to kick it off with you because you sit at a unique perspective of the private markets. Explain to us how you are working with different types of VCs.
Yeah, so we are a strategic communications firm, and we work actually beyond VCs, but with hedge funds, private equity firms, and other alternative investment managers. And since we are focused exclusively on that space, we're kind of working across their evolution, including working with deal flow around deal announcements, also working with the media to try to understand kind of what the trends are and how a manager might be able to position themselves differently that way.
Yeah, and you certainly have been on trend because there has been tremendous growth within, the interest of private market investments.
Absolutely, yeah, and it's an ever-evolving space with different tools that managers are using, including social media, beyond the traditional media.
Yeah, Jon, let's talk about the environment more specific to the market. Your overall thoughts on the macro?
Well, actually, it's interesting from our perspective, because we're constantly looking mainly at the M&A markets and how the macro is affecting M&A. And for us, when credit is tough to achieve and there's noise around tariffs or other geopolitical activity, processes get paused, they get delayed, they get pulled, and then they turn to our market, which is the secondary market, for alternative solutions. And so in periods of volatility, it really helps to have solutions that we can provide our clients to address and still create liquidity solutions for sponsors and their portfolio companies.
Yeah, and Abdul, you're seeing the same thing as well as companies look for alternative forms of capital, with the IPO markets being somewhat muted at this point.
Yes, exactly. I think over the last few years, we haven't had many exits, especially where I spent time in the fintech ecosystem. There was a lot of excitement kind of at the end of last year, but due to the macro uncertainty, some of the things happening with tariffs, companies pulling back on purchases, it's been a lot harder, and some of the companies that were slated to go public earlier this year have ended up delaying or pausing those strategies. And now what you're seeing is, from an LP perspective and a VC perspective, with the lack of exits, there's less liquidity and funds giving back to LPs and institutional investors, which means they can also allocate to new funds in the manner that we would have hoped by this point this year.
Yeah, Taylor, what are some of the concerns that you're hearing from clients overall in terms of how they're positioning their messaging or thinking about, the volatility that we've seen in the environment?
Yeah, I think it depends on the strategy and also what asset they're in, if they're private equity or if they're in a hedge fund in the public markets. The big thing that we always work with our clients on is understanding what your strategy is and then who the audiences are. So trying to figure out, are the public markets, the volatility there, how is it impacting our strategy, and what are our LPs thinking and what are they worried about? So identifying kind of areas where we might be able to differentiate them or separate them from the noise, right? So if there's an overall view that the public markets are causing havoc across the entire alternative space, why is your strategy different, and where can we start, to interject that narrative either, across your own narrative or your own collateral, or with traditional media or social media as well.
Yeah, and speaking of differentiation, Jon, you're seeing sector and asset specialization emerging out of this environment as well.
Yeah, very much so. We're seeing a lot of sponsors starting, new business lines, raising capital specifically dedicated to doing continuation funds of other sponsors' deals. Last year, one of the trends we saw kind of building on the same theme was we saw a couple opportunities where sponsors took companies private through continuation fund transactions, which was something we hadn't seen before. So there were, several of those transactions, including one we were involved with, to help a sponsor just take all that volatility out of their portfolio.
So would the expectation be that they'd go back public at some point or continue to...
Or find a strategic acquirer that maybe wasn't available at the time when they did the initial IPO.
Yeah.
Yeah.
This is also lending to the growth in the secondary market as well. So give us some background on that and why that shift is occurring.
Yeah, as John touched on, I think all investment managers are looking for liquidity for their investors, and also startups are looking for liquidity for their employees. So you're seeing a lot more activity in the secondary markets. Employees of very late stage growth companies that are selling on secondary markets. You're seeing GPs also usually leading secondary opportunities through continuation funds, sometimes enabling them to hold on to really prized assets, while still providing liquidity to their investors. And you're also seeing LP-led opportunities where they're selling secondaries to other, investors as well. So there's definitely a lot of growth in the secondaries markets over the past few years in the venture ecosystem.
So it sounds like staying private for longer is a trend that's in place, which I mean, it kind of lends to the investor demand that you're seeing for these types of products, particularly in the private credit space, as an example.
Exactly.
As alternative forms of lending. It's interesting. We know why credit has come to the forefront. Out of the GFC and how lending standards had changed and so forth. It's interesting. We had a similar panel talking about that, but the mortgage market could potentially be the next area within private credit if it's not already.
Yeah. Well, so private credit secondaries is a huge and growing area because the environment. Obviously, it's very interest rate sensitive, but at the current time, there is a trade to be done. I think in some other periods of time, the bid-ask spreads have been just too wide. But right now we're in a pretty optimal environment for private credit secondaries to really take hold in the market, and there's dedicated funds going back to sector specialization that are just specifically targeting those types of opportunities.
Right. I would imagine AI, tech-driven, or the areas within the sectors that are
within credit.
Right.
Yeah. And even more broadly, I would say, there's a lot of credit, like alternative credit, like investment opportunities that are fitting within the mandates of the credit secondary funds.
Yeah. Is it still AI driven, still a very tech driven environment? Anything else emerging, such as healthcare?
Yeah, I mean, almost 2/3 of opportunities that we're seeing in the early stages now are AI first or AI native companies.
Yeah.
So you're seeing companies that are getting formed over the last year being AI first. You're seeing companies that were formed a few years ago also pivoting to be AI first or AI enabled. And so a lot of capital is going into the AI space. And there's really good reasons for that, right? It's a huge, massive replatforming opportunity. It's just similar to the internet and mobile. AI is going to really fundamentally change how we do a lot of things, both on the consumer side and for businesses. At the same time, AI is also expanding the market size, where you have, AI being able to do some of the manual tasks that humans used to do. So they're not only going after software and technology budgets, they're also going after budgets for labor, which are multiple times higher than software budgets. So these companies are scaling a lot faster with less people as well. So they're able to raise more capital at a higher valuation, and that's why you see companies like OpenAI raising $40 billion, almost half of the North America venture fundraise over the last 4 months.
Yeah, what is it, like 10 to 15 companies that, or I think SpaceX is one of those that's
yeah,
within that
exactly.
mix as well, where there's so much demand for it. I mean, whether they hit the public markets or not is anyone's guess. But
yeah, and there's a huge need for secondary liquidity in those companies, whether it's employees or early investors or what have you. And there's a huge opportunity there, and I think capital will flow into those situations.
Yeah.
Yeah, John, are you finding that having to educate, because I know there's a lot of new entrants in the secondary space in terms of the LP universe. Are you finding the need to educate the traditional GP LPs, as you're working through these deals?
Well, I think communication, in continuation funds, right? You have a number of different interested parties, and that's what makes the transactions really fun to work on, but also hard to execute.
Right.
Because you have the sponsor, you have, in many cases, hundreds of underlying LPs in the fund. You have the management teams of the company, and so getting all of that right and making sure that the communication is appropriate across that entire spectrum of participants, makes it a pretty interesting and complicated transaction. And I think over communicating is kind of like where we are as an industry to make sure everyone has all the information they need. Similar to what you would see like in a public process.
It just seems like the competing priorities and their time horizons have to make that pretty complex and challenging.
Yeah, we do need to compress the time frame for sure.
Yeah.
These transactions, particularly the ones of scale, take quite a long time to execute.
Yeah, and I think the lead up to that too, I think from our seat, when we work with a GP on a portfolio company, we also often engage with the portfolio company itself to try to establish what that partnership has been like over the the first ownership, so that once they go, hopefully it's helpful once they go to market as a CV, to show that we are intimately involved with this company. We understand the market, we understand what the opportunity set is, and we continue to be the right partner for it moving forward.
I think management teams tend to like continuation funds because they're staying with the same partner that they've had for 3, 5, 8 years. So it's kind of more of the same for them, and there is a liquidity option available to them as part of these transactions. And sometimes there's changes in management that occur as a result of this extended holding period, and this gives them the opportunity to kind of like get through that phase of ownership.
Right.
John, one of the things you touched on was just how long the transactions take. One of the things that we've been finding, we spend a lot of time at F Prime in looking at wealth tech as well, and we're starting to see a lot of platforms that are also coming to market that are trying to digitize and reduce some of the manual processes that are required to be able to coordinate that that transaction. And so we're seeing some opportunities there where it's going to continue to be democratized as well. More folks are going to be able to participate, and it's going to be done in a very tech native and easier and more seamless platform. So I think that's probably some of the changes that we see coming down the
Yeah, and there's been retail appetite for these transactions, and that's a whole new investor universe to help fuel the growth of this industry.
Yeah, and certainly if there's demand for the product, they'll certainly supply it.
Exactly.
That's for sure. But then, you also, these types of products are different than your traditional funds and ETF wrappers and so forth, and the underlying is very different than.
Yeah, it's kind of like stock picking, because you're looking a significant portion of the deals are single asset.
Well, I mean, in a way, you are probably applying more fundamental analysis to it than you would in the public market, as an example, because you don't have necessarily the comparisons of valuations and external forces that are driving, the stock that have nothing to do with the fundamentals. I mean, we see it every day with the tariff talks.
Yep.
Right.
Right.
Oh, I'm sorry. I thought you had something to say. Do you think, Abdul, that the space is perhaps getting a little bit overcrowded when you think about AI? Or as an example, using Moore's Law, the technology is evolving so quick. So a startup in 2021, is it even relevant now, or are they continuing to evolve with each iteration of this technology?
Yeah, I mean, when we're making investments, we spend a lot of time looking at the founders and the technical, kind of like their technical expertise and their ability to stay at the forefront, right? I think that is like what everyone is trying to figure out. How do I continue to be at the cutting edge while at the same time looking at what the larger companies, some of the first movers in the space are doing, and what's defensible and durable that I can build that doesn't end up getting encroached on by say an OpenAI at some point. So that's something that we spend a lot of time thinking about. But I do think it's a massive market, and AI is just going to continue to change how we do things, and we're starting to see some of the work that was previously 6 months ago too complex for an AI agent to do, they're able to do that today. And with each iteration getting faster and faster and the models getting better, there's going to be more complex tasks that
there was a story this week about coding, where CNBC reported it. I don't remember exactly what it was about, but virtually anyone can code now based on mood, I believe it was.
And I mean, there's a lot of talk of like the first one-person unicorn as an example, where you don't need as many team members to be able to build a massive company.
Yeah, well, I guess it makes them attractive targets, rather than having to reinvent the wheel at a massive multi-billion-dollar, multi-trillion-dollar company. You can swipe these companies up and then be able to grow that at scale.
Exactly. You saw that, I think, with OpenAI acquiring one of the companies that was in that space.
Right, because the smaller companies, to your point, if you talk about the one-person unicorn, that shows how nimble they can be, but they certainly need to scale, for sure. You brought up an interesting point about hedge funds and private companies using social media and LinkedIn, which typically you wouldn't think they would be as exposed as that. How are they leveraging social media in an effective way? Yeah,
so we've been looking at social media now since 2012, and how hedge funds and the larger private equity firms are using it and have been leveraging it. And I'm sure you can imagine, has evolved immensely in the last 12 or 13 years. Generally, it has been more of a defensive mechanism to communicate what the key messages are. This is our profile. There's not any, to try to eliminate confusion if there's someone who's posted something, because there really was no limitations or restrictions on what people could post, and start being as kind of viewing as imposters. But recently we're starting to see a lot more proactive, even with targeted ads, On the hedge fund side, a lot of that is recruiting. You're seeing that with the pod shops. And then on the private equity side, what we have found historically is as the larger, the major private equity players go, the market will follow. And we actually recently just completed a research study on how they're using targeted ads, and almost 80% of the larger private equity firms we looked at have been leveraging their deal announcements or other firm developments, thought leadership over social media and using these targeted ads to put it right in front of the audiences they're trying to reach. But when you look at the middle market, it's less than 10%. So there's a huge disconnect there, and I think as we start moving forward, being able to really leverage this, which is it's an interesting way to be able to put it right in front of the audience that you're trying to reach.
It really is, and you're seeing that public companies as well, with CEOs and other members of senior leadership, where they're rather than through traditional press releases, to your point, they're getting right in front of their audiences on LinkedIn.
Correct.
As an example. I think that's a really interesting trend.
Right, and even when you go to the traditional press release, this is a way to supplement it, right? So you're putting it out there for everyone to see, but this way you can actually put it in the feed of the people that you're trying to reach.
Right, because only so many people have access to press release.
Well, the press releases are going to go out pretty broadly, but
right.
if you don't see the PR Newswire, if you don't see it over the media, the traditional media, if you're on LinkedIn and you are John, for you, if you're an LP, we're able to put it in there, or if you're a portfolio company, we can put it in front of other management teams to show how that GP has been engaging with this portfolio company. It can bring in deal flow, it can bring in other opportunities, and it can put you in front of the investors.
Yes, it's an amazing tool for deal flow.
So it changes the way that you would traditionally get a meeting, as an example, or how you...
Potentially, but yeah, I think if people read about a deal that we're doing and they see it through the social media channels, maybe they have a similar portfolio company and they just want to understand what their competitors are doing or how capital could be raised for that type of opportunity, particularly as the alts universe expands across all these different sectors. You look at how deep the real estate market is. There's a lot of sponsors that are in the real estate market that maybe they don't even have proper funds, right? They're more independent sponsor-like, and they're raising capital on a deal-by-deal basis, and they see what's happening kind of at the larger end of the market and how it's flowing down in the middle market through these social media channels, and creates a lot of new conversations.
Yeah, I also think, Taylor, to your point, in terms of acquiring the right skill set, because demographics are turning themselves over since 2012. Look how different, whether new entrants or people within these spaces, how their careers and their skill sets have evolved.
We've seen there have been a number of surveys that have showed that LinkedIn is as important as the FT and Wall Street Journal now in terms of how people are digesting their news. So
yeah, would you agree with that? Even with new demographics or younger generation of private market professionals coming in.
Yeah, I mean, we see a lot of venture capital managers and GPs active on social media, especially LinkedIn, as just given how professionalized it is and how easy it is to follow the right folks to be able to get insights in the categories that you're most interested in. So.
Yeah, I think that's the big thing is it's an interested audience, right? You're not blasting it out there to people who really don't care or aren't going to be able to move the needle for you, but you can put it right into the right group of people.
And I think similar to unlike other social media platforms, they haven't changed how their algorithms work and things like that. So it's still easier to continue doing things the way you're doing, continue to grow your audience base, and to have the engagement that previously you've enjoyed as a firm.
Right. It's not as, I don't want to say consumer or retail, but it's very specific to the job market, professionals, and so forth. It's almost, I think we learned a lot going through COVID into hybrid environments as well, where you didn't just have to be in New York or San Francisco or Chicago or London, where with hybrid settings, you can bring in that diversity of talent and experience, right, which I think lends to what you see on platforms and how money is being raised and crowdsourcing, crowdfunding these days. So the dynamic has really shifted. Would you
Absolutely.
agree? Yeah,
for sure.
Shifted. All right, appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.